Good morning, everybody, and welcome to the Daily Energy Markets podcast. It is the 31st of January. Would you believe it? January 2025 is just about over, and Brent crude oil is trading a little change this morning, 77.27, up 0.5%, but give or take each day this week, up or down 0.5%. It seems oil markets are stuck in a very tight range after a first half of January that saw all sorts of uncertainty drive the oil price above $80 a barrel. The fear of the Trump empire arriving was possibly greater than the reality that it's landing. Andy Lavin, your thoughts on that this morning? Why are these oil markets uninterested in Donald Trump?
I think the honest answer to that is because nobody actually knows what's going to happen. You hear this enormous amount of rhetoric being pushed out there by him and by his cabinet, and then the next day it can be totally different. And you saw that with the freeze on aid, right? And freeze on federal grants. It's like yes, no. You're seeing it, going to see it this weekend with tariffs on Canada and Mexico, which he thinks is going to do something to their deficit. You saw that with him and Colombia in terms of the returning of illegal migrants. I think it's better to wait and see what happens, what really happens, rather than just the words. And I think that's why everybody's kind of, well, yeah, they'll do what they do. When it happens, it happens. When it has the impact, we'll take it into account. Now I've got my own problems. I'm just going to focus what I'm doing.
Gaurav Sharma, a journalist and energy analyst. Gaurav, your thoughts on that? Because ultimately, if you're putting a bet on oil and you're taking positions in any asset, you've got to see where the risk here. Ultimately, this market is saying it doesn't see the risk of Donald Trump because ultimately we're not seeing that elevation on the upside. That all the noise of Trump doesn't equal risk of great concern to the energy markets. At least that's one interpretation. Your thoughts?
See, there's the good morning, Sean. Good to be here. If you look at it, it's the Trump show, but the Trump show hasn't yet gotten off the ground, I would say, in my humble opinion. And what that does is he'll say one soundbite, let's call on OPEC. Please, we need cheaper oil prices. Then let's impose tariffs. Then let's say drill, baby, drill. And so it goes. You see, and the classic paradox in the data is that you say drill, baby, drill, and the Baker Hughes rig count actually falls. So it's not easy. It's not easy. Another thing is the Americans are producing at a canter, at least. They're still north of 13 million barrels per day, right? There is not a whole lot of room. And all sorts of empirical and anecdotal evidence suggests that the production will actually come a shade down, not higher. So the Trump show is yet to get off the ground. At the same time, you had this thing before he came into office of Biden sort of enhancing the sanctions on Russia. That kind of is the only thing that's really playing out. So if you look at the differential between the Dubai crude and Brent, the premium is at its highest in a very long time, I suspect a decade. And what are we looking at? Sort of Bloomberg data is saying we look about 450,000 options of interest. So there you have it. The market is still trying to suss him out. He's an unpredictable character who says one thing one day, one thing another day. And then if you have the specter of trade tariffs, that is sort of bearish for oil.
James McCallum, CEO and Chairman of Exergy Group and Professor of Energy at Strathclyde University. Welcome back, James.
Thank you, Sean.
Happy New Year from the Daily Energy Markets podcast to you. We've seen in recent days, James, the earnings results from the oil industry, the Shell most pronounced, it's still talking about possibly moving its listing to the US was one of the headlines that came out of its earnings where it failed to reach target but maintained dividend commitments. And then we saw Baker Hughes surprise on the upside. Your thoughts, firstly, on the health of where the oil industry, the energy industry, and it's, it bet big on the horse that is Donald Trump. Have they got what they bet for?
Look, the long and the short is you certainly with Donald Trump, you've got what you bet for. I think Gaurav sort of summed it up very accurately there. You get a president whose words are, laced with contradiction, and you take the version of the words that you want to associate with. The reality is that there is little change in terms of the super major oil prices as our share prices as a general rule. Shell's move is to try to close the gap between themselves listed on a European London Stock Exchange and where their competitors are getting their share price elevation from in New York. So it's not about what Shell does, it's about how you effectively get more comparable with Chevron, Exxon, Occidental. If you look at the oilfield services, there's a nice story on the News Digest this morning around Baker Hughes's earnings report, which could lead you to believe, oilfield services is up. But if you read a little deeper, you'll see that that's not the case. The oilfield services division within Baker Hughes actually lost money in the last year. It's gas technology particularly around the refining technology, compressors, turbines, etc., that's driven Baker Hughes's share price. So all the oilfield services are down. Baker Hughes Rig Index is down. Oil companies, as a general rule, are down, which just simply tells you that nobody is buying into this drill baby drill story being a good outcome for the oil and gas companies. And when it all comes down to it, I made this point last year repeatedly, Sean, at these kind of prices, there isn't the upside in the Permian Basin. And so any activity that's going on in the US just now is all around gas. It's not around oil.
And I would imagine, James, it's also around maintaining production capacity given the decline rates in the shale patch.
It is. I mean, the Permian Basin has for the last 2-3 years always been around recompletions, and I guess there's if you want an entertainment show to kind of tell you how all of that's playing out, there's a wonderful show come on air on Netflix just now called Landman. And for the drillers in the room, a landman is a person that finds the licenses that you then go on to drill on, or indeed to work over rigs. It gives you a great context of the American and the Permian oil and gas scene from an entertainment standpoint. So I encourage people to go watch it. It is incredibly close to the reality in terms of what's actually going on and how the US producers, particularly the independents, have had to respond to the prices that the market is showing now and certainly for the foreseeable future.
Andy, there's been, I mean, we spent a lot of last year sort of with the backdrop of the geopolitical risks to oil, I mean, the concerns of the wars in the Middle East and Europe, and ultimately, bar brief moments, they didn't disrupt or elevate the oil price because nobody ever really believed that they would do so, and they were more or less correct. Oil flowed, gas flowed, and got to market. The same seems to be the case here. All the noise of Trump, nobody really believes, do they, that he's going to stop oil exports from Canada and Mexico into the US? Your thoughts on that? I mean, that adds up to being well over 3-4 million barrels of oil a day. I mean, the American economy would collapse if the Canadians and the Mexicans responded by stop sending the stuff. I mean, it just seems like a non-starter, and that's why the oil markets aren't even blinking.
Yes, is the simple answer to that. I think a lot of what he says is for impact. It's not necessarily what he will do, but ultimately what he could do. And you saw that with the Colombian shenanigans. I think the reality is if you stand back and just say, well, clearly from the oil price, the market is roughly balanced today. It may not be going the same place as it has historically, but it's roughly balanced. Now, if you talk about somebody bringing on new production, well, there's a whole bunch of shut-in production in OPEC that can come on much cheaper than in already drilling or recompleting new wells. So why would you make that decision when there's a risk that if you start going for market share, the guys that actually have all this shut-in production and can just go, oh, you can have some more with like a little turn of the tap, it doesn't make any economic sense to do it. When you drill a new well, you're investing for the next 5, 10, 15 years.
Yeah, but in a way that hasn't proven to be correct, Andy, in the sense that we saw out of Guyana and the US in last 2 or 3 years, massive increase in production at a time when OPEC Plus kept everything shut in the ground. OPEC Plus seemed to be willing to keep shut in while others keep expanding. Why wouldn't that just continue this year?
Because currently it's on the edge of their pain threshold. If you start to see more rest of the world production coming on stream in excess of the demand, they're faced with either allowing the oil price to drop and increasing their deficits, or they're going to have to pump more, which will drop the price even further. So there is this, I'm certain, I mean, I'm not party to the conversations, but I would expect there to be this very uneasy balance inside, which is, I just hope it stays the way it is, because otherwise we're damned if we do and we're damned if we don't, because they lose or lose, right? And in that situation, the real challenge is OPEC get Phil there, pushed in the corner and say, right, that's fine, you guys. We can sit on this and we're going to push oil price down to $10. And you know who's going to last? And it ain't going to be the rest of the world.
Gaurav, the supply side seems to be clear enough ultimately that there's just a lot of the stuff around, and we should be happy with $75 a barrel oil, really, when you think the amount of idle capacity there is in the world. So the question is, where is demand? Where's the outlook for demand this year? We're starting a year where there's a much more bearish tone on China that a year ago, the opposite was the case. Are we overbearing China?
To a certain extent, and there seems to be a lot of focus on India as well. Keep talking on about EIA, IEA. Everybody's saying about India is going to account for 25% of this demand, or that demand. Everybody's putting forecasts and projections out. You see, the Indian economy may be growing at a fair pace, but it's flat relative to last year. It's still about sort of 6.4, 6.5. That's the projection for 2025. I don't think the global market can totally rely on India. Now, what are the Indians doing? They're diversifying their pool. They had 27 suppliers. Now there are 40 suppliers, Guyana being one of those. These guys have no shortage, as you were just discussing with Jameson, and they have no shortage of crude out in the global markets, especially light sweet crude. Now, look at China. The internal Chinese forecast by some of their biggest petrochemical manufacturers, they're saying that in the fullness of time, Chinese demand is going to come substantially down, especially when it comes to human mobility in that part of the world. I think we're over-egging this whole India thing. China's demand is really not going to be what it was like, even at the turn of the decade before, end of the last decade before COVID clobbered it. So I think we're sort of playing our hand. It remains a story of demand, and there is still an awful lot of light sweet crude out in the market to service that demand. So I'm not very positive. I think I remain bearish. I also agree with Andy that by the time the OPEC seminar comes around July, we will have some sort of shift, because OPEC is in a pickle of its own making, and looks like it will pump more this year.
And the story out of India seems to be also getting a little bit less than great. It's sort of party seems to be over. Some interesting reporting there to watch. James, in some regards, it seems the new demand center that is going to be the competitive place this year is Africa. Africa's day is kind of come. We've got the opening of the Dangote refinery now, massive new refinery into supplying products into Africa, where most others have been, and particularly the Middle Eastern new refineries have been looking to compete in Africa. Your thoughts where Africa can go? Is another false dawn for Africa, or is this one, do you think, going to be potentially deliver more than in the past?
I mean, look, Africa remains the global sleeping giant. If it could get its act together, then anything is possible in Africa. But it's a long-term play. I mean, in some ways, it plays into something we had a little conversation just before we came on air, Sean. For me, the two things that are playing out in the conversation we've had so far today is it's a stability issue for OPEC. How do I maintain stability? How do I maintain stability against a backdrop of supply of crude is not the issue. Demand is the issue. And then you've got Trump, who's on the other side, and whether I agree with Trump or otherwise, he is simply sending a message to the rest of the world, which is take responsibility for your own economy, for your own actions, for your own strategy, and including energy strategy, because I'm taking entire responsibility for Planet US. And I think for me, in some ways, I welcome that, Sean, because, obviously as a European, Europe has tagged along on the shirt tails of the United States, for almost most of my life. And the reality is, and that has led to a failed European experiment. It has led to the United Kingdom leaving in Brexit. But there is very, very little cohesive strategy around where we go. And that is what will impact demand. So the reality is if you look at China, China's definitely taking responsibility for its own actions. Gaurav has quite eloquently pointed out that in the last decade, India very, very, very carefully taking responsibility for its actions. Europe lost, the United States under Trump coming back very strongly, and Africa, the unknown commodity, the absolute unknown commodity. So it's great to see investment going into Africa, but it's very early stage.
Andy, of course, the planet Trump, as James refers to it, ultimately the reality of the world is going to be not the tariffs that Trump puts on Mexico and Canada this weekend as the sort of latest in the target box, but ultimately how those countries respond. Where is the punch back? Because obviously this isn't one man in the ring by himself. There will be responses. And the question is, what do those responses look like? Again, there doesn't seem to be a belief in the energy markets and the oil markets at the moment that the responses end up in a global trade war, which is what the concerns were before Trump came into office. There does feel like there's a creep. You said, or Gaurav said, that the show hasn't started yet, but it looks to me like the financial markets are not believing the bluster of Trump, because the punchbacks and the trade war that would deliver would ultimately be bad for everybody. Your thoughts on where the market's at about the punching back from elsewhere, whether it be Europe, Canada, Mexico, that they will or won't lead to depressed demand for energy?
I think the challenge is that at one level, there are very local issues. So if you look at the argument between the US and Colombia, that was kind of all done and dusted in kind of less than 24 hours almost. And actually, you look in the newspapers and it's reported in very different ways. Some people say Trump won, some people say the Colombians won. It's kind of not clear what's going on, but it just impacted them. So I think when you look at Mexico and you look at the US and you look at Canada and you look at the US, they'll probably play out in a similar vein, right? So the Trump is going to put tariffs on Canada. Canada will respond, and there'll be this confrontation between the US and Canada, and the rest of the world is going, oh, that's interesting. So now we can see how it plays out, right? So arguably, what is happening is the market is saying, so whilst this is playing out at a local level, all of those people that are going to get impacted down the line, for example, China, can get prepared and then can be, well, fine, you want to put tariffs on, that's not a problem. We'll stop sending you iPhones. Or etc., etc. And you can see that with some of the restrictions that China have put on in terms of exporting technology and engineers, just getting ready to hit back. But even China-US, part of me kind of says, why would that impact all of us? Because it's going to be tariffs from China to the US. It's going to be tariffs from the US to China. It's going to be a prevention of trade between those two countries, nothing else. I think of all of it, China will go, you know what? Okay, if you don't want to do business with us, that's fine. There's the rest of the world. You're only 300 and something million people. There's a bigger world out there, a bigger market.
And it seems there. I mean, that sort of pursuit of new markets is many years in the making, right? BRICS
Yep.
started 20 years ago in its informal sense, but ultimately gaining momentum. Let's go to the survey question, which obviously tackles this point. Why do the oil markets appear unconcerned about Trump's 25% tariffs due to land on Mexico and Canada tomorrow, February the 1st? Because one, it won't include oil, and hence the oil markets aren't concerned. Two, the trade war won't last long. Or three, there's ample supply, oil supply in the world. And so, like last year, where the markets never really got too concerned about the threats of Trump, or got last year about the threat of the conflicts in the world disrupting oil supply. This year, the markets start with sort of view that there's plenty of supply, so whatever Trump does, it's not it can be dealt with. Or for none of the above. So oil markets unconcerned about what seems like in any other day of the week in a normal year, 25% tariffs on your biggest trade partners is kaboom. On this occasion, this markets, not only the oil markets, but the much more sensitive equity markets, equally unconcerned. So Gaurav, on that point, I'm still trying to digest the news earlier this week about the AI developments in China, which then sent the equity markets into a sort of a big heart attack, but it seemed to be a very brief heart attack. Did that give us some window into where the sensitivities are to risk at the moment, that Trump and that the markets are on edge? Or did it tell you how resilient the equity markets are because they took the digest and went back to the party? Your thoughts on what happened this week, and should we still be thinking about it?
Markets, by their very nature, Sean, are pretty fickle. It happened. People saw a window of
I mean,
opportunity.
this is not, if I have to challenge that thesis, ultimately, this equity market is not fickle. It has one direction for a decade, and it's the climb to the highest peak it sees. It's been the most consistent thing on the planet. The next
Yes.
altitude, I'm going there.
Fair enough. But you see, the faces of pockets by which people see an opportunity to do a bit of profit taking. This happened to be one of those. Yes, it's a one-way street up. I get that bit,
I
especially.
mean, it's not 2% off the oil price for whatever reasons.
Yeah.
I'm still trying to understand.
You see, these are just one of those factors that as it develops, people have their sound bites. The Chinese copied it. They did this. They did that. That's a big threat. It's a cheap entry point for AI. These things are It's just a development that happens. Now, if you look at AI itself and how it's deployed in the energy industry, a lot of people view AI as a service. You are not going to run a refinery on open source AI. You're going to get a specialist product from one of the vendors that suits your purposes, that is kind of bespoke, being developed for you. So it has it matters in a global context. It does, but not in a very specific commercial context. Now, another thing is, people are saying it'll be a cheap entry point, or that it's open source and everything else. That's fine, but it does not append the commercial models that people have envisaged for AI to the extent that was made out to be in the 48 hours that it hit. And then suddenly we had the rollback. We had the bosses of Microsoft, Facebook, etc., saying it's actually a good development. That once the whole noise dies down, this is actually a force for good. So, that coupled with the fact that this whole thing about trade wars, they're not going to last.
I mean, ultimately, it's less demand on energy, I suppose. That's what we learned. And whatever way this solution comes, it could be there. James, my thoughts, I wanted to get your insights. Europe, are we, this sort of crazy Trump show that's the second coming, and everybody's focused on it, obviously, because it just is the usual kind of shenanigans. But ultimately, the real story is Angela Merkel coming out from the darkness and the silence to make very strong comments about her successors in Germany doing a deal with the far right. And where are other real issues going in terms of Europe's future, that these are really the focus areas that we need to be paying attention to. Where do you think Europe is now at the beginning of this year, and its vulnerabilities and relativity to sort of stability of growth and energy demand and such things?
So a lot of questions in there, Sean.
Yeah.
So the reality is, if you take Europe and the US,
I mean, ultimately, the question is we need to keep our focus away from Trump, because despite all the noise, there's predictability, but the real news might be elsewhere.
Yeah, look. Trump is doing what Trump does. He's very candid about the fact that he's a businessman. He's very outspoken about the fact he's going to bring a business focus. And what he is doing right now is he is throwing stuff out there and throwing it at the wall and waiting to see what will stick. It's a negotiating tactic. What kind of opportunities will exist for me if I throw a big idea out there and I watch what happens?
If you say he's a businessman, right, and then he ultimately has a bottom line, and you know that because you're a very successful entrepreneur and had very good bottom lines. What is his bottom line? Is it the S&P 500 that has to keep shining? And so every decision he ultimately makes is not going to jeopardize that? I mean, it seems, what is his bottom line in order for us to have some sense of North Star? Because I think his bottom line is somewhere around there, and he's not going to do any of this stuff that's going to jeopardize that.
Look, yeah. So look, it's amazing some of the stuff that he puts out there, and that people don't go, oh, hang on a second, wait a minute. And the classic is I'm going to make America great again. America. If you take a look, you just made the point. The American stock markets are at an all-time high. America is not in the toilet at all in terms of where it's actually at. So the reality is he is tweaking at the edges. He has a 4-year term. He wants to go into the history books. As a business person, I think he genuinely wants to come off the back of 4 years where he maintains the growth within the United States. And in maintaining it, he will take responsibility for it. Look at what I did. And the point you're making is that inherently within the markets at the present moment in time, it would seem that he only just has to sit on the horse and it'll take him there, without doing anything too radical. Europe's in a very different position. Europe is in a place where growth has stagnated, particularly in the UK, Germany, France, the big economies of Europe. It is flat at best. And the issue that you were asking about, so where's Angela Merkel going? Where's the move to the right going? It's all around how people feel the pain of what's going on in Europe just now in their pockets. The price of energy, access to the price of electricity, a real bugbear for the politicians in Europe. And that is what is actually happening. We've seen in the last week, United States pausing on interest rate cuts, Europe pressing ahead and making it very clear that Lagarde sees several other interest rates coming through over the course of the rest of 2025. So these two economies are going in almost opposite directions at the present moment in time, and there is no clear leadership within Europe as to how that changes. If I may, Sean, I'd just like to come back on a couple of points which you made about artificial intelligence and the point which Gaurav made. So the answer to your question as to why did oil prices drop was because a big part of the story was that there was less energy consumption required for this new form of artificial intelligence. And with less energy required, clearly that has an impact on all forms of energy. It had an even bigger impact on nuclear stocks if you took a look at it, because it sort of like pushed against this view that we're going to have new nuclear plants everywhere to power AI. Now, picking up on Gaurav's point, the reality is I think we're going to end up with two kinds of AI. We are definitely going to end up with OpenAI, which was the bit that pushed against the AI stocks and said that there's going to be an alternative in terms of the choices that are available to you as this market unfolds. But when it came down to it, the approach that the Chinese technology actually takes is somebody sat back and went, do you know what? I'm not entirely sure we need to actually calculate things to 20 decimal points here. I actually think we could actually get away with an 80-20 solution here that actually takes it to 4 decimal points. That's more than enough. It uses a fraction of the energy to do that, and it gives you an answer that enables you to progress and move forward. Artificial intelligence is all about, or the application of it is all about a business, a process becoming the best version of itself that it can be. And what happened last week was we suddenly opened a window on the fact that we are not limited to one geomarket in terms of its provision. We're going to have a wider supply in that particular space. That's a good thing. It's a good thing that we'll end up with 2 different systems. Governments will undoubtedly use the sort of 20-point decimal place accuracy because they need to have that, which is Gaurav's point. Markets, businesses, companies, small companies in particular, will be more than happy with the 80-20 solution. So it's a very positive thing.
Andy, although the time has been eaten a little bit, I wanted to get a comment from you on where are your former community of trading peers starting this year after a few years of just making so much money? It's like they don't, they can't buy bigger yachts. I mean, ultimately they can't get bigger houses and so forth. But this is a year that starts with a different outlook, and not only from the point of view of what the opportunity is, but also an increasingly crowded space now that we have literally every NOC in the Gulf now opening a trading house. What do you think the world looks like from your peer group, former peer group at the beginning of this year? It seems like the first year in a while that things look a little bit different.
So I think I would say there's 2 things. Firstly, it's a lot about diversification, and you can see that in some of the major trading companies looking outside of oil and gas in a much bigger way than they have historically done. So diversification is the first thing. The second is that actually, although kind of the public looks at trading as a way that people make money, in reality, if you look at what the activity of that is, it is rebalancing the markets. And anywhere you get disruption, you're going to have opportunities to rebalance the markets. And we continue, even though the price has been trading relatively flat, there is still disruptions, and there will continue to be disruptions. There will be disruptions if the Russia-Ukraine war is stopped. There will be disruptions all over the world as markets change, markets grow, markets don't grow. I think one of the really interesting things is going to be China and where the growth is going to come from, because I think we should be very wary of dismissing China from saying we've hit peak oil. If China says we've hit peak oil, they've probably hit peak oil. That doesn't necessarily mean the world's hit peak oil. And you've seen people reporting about, well, yeah, if the transition gets pushed out, we're going to need more oil. Where's that going to come from? So there are still going to be disruptions and flows of oil and gas and products between regions that somebody needs to make happen. And that's where the traders come in. So I think what you've got is you've diversification on one side, and then probably more of a focus on the fundamentals of balancing the market.
Well, we're going to have to balance this market and get off air so we can all go back to work and earn a bob. What's the survey result? The market's uninteresting in this tariff issue because there's ample oil supply in the world getting most of the votes here. We'll post that on social and see what the rest of the world thinks. Gaurav Sharma, as always, lovely to have you back. James McCallum, Andrew Lavin, top of the class. Thank you, guys. Have a great weekend. Catch up with you soon.
Thank you very much, guys.
Thanks,
Bye-bye.
guys.
Bye-bye.